Right, welcome to our 2023 class in corporate finance, where we'll be learning your role as a financial manager. Now, in corporate finance, this is one course that entitles each one of you to be called financial managers. In this regard, the objectives of this class will be to explain to you the role that financial managers do, and also to describe their decisions in 4 major terms. We're also going to identify the goals of a firm and understand why maximizing their wealth is more preferred to achieving the objectives of a firm. We also want to understand the problems arising from management of a corporation and ownership. We'll also demonstrate what corporate governance is and understand the different forms of these organizations. So the role of financial management or corporate finance, number one, is to achieve the goals of a firm. Number two, we're going to look at the role of financial management in terms of corporate governance, and we're going to split it in the form of different kinds of businesses. So to start with, corporate finance or financial management can be defined as the management of finances of an organization in order to achieve their financial objectives. So the concerns that we need to look at here require us to look at the acquisition, financing, and management of these assets by the financial manager. And so the roles or the goals of financial management could be split in 4 key categories. And these 4 key categories are what summarize your syllabus. So financial manager must have what are called investment decisions, financing decisions, dividend decisions, and asset management decisions. So when you're dealing with dividend, or let me start with investment decisions, we're looking at the investment that should be committed to expect a future return, the sacrifice of a present value to be earned in future. It involves risk management. It involves time factor and also the rate of returns. So we're going to look at a manager who's going to look at the sacrifice of investments now, which we call the present value. So what are concerned under financial investment decisions? The manager wants to know what the optimal size of a firm is, what specific assets must be acquired, if any, what assets should be reduced or eliminated. We also have financing decisions that will trigger a financial manager to understanding the type of financing, whether short or long term. Also, to understand the financing mix. We call this a capital structure. What should it comprise of? By now, we must understand that the sources of finance for any organization could be from the owners of the businesses who are the shareholders. We call that share capital. It could also be from debt financing or retained earnings. So this is what we call the financial mix. And also how these funds will be acquired, the cost of this so-called capital. Then we also have dividend policy, which happens to be part of the syllabus, where we're going to identify the best dividend policy, the retained earnings, which are a cheaper source of finances. We know that this one does not accrue any interest. And peradventure, look at the appropriate dividend policy that has an effect on the share price and the behavior of the shareholders. We also look at the optimum policy that will optimize the market value for the shareholders. And asset management decisions, here we're looking at how efficient the assets that are in this business, how they are being efficiently used. So we also have a greater emphasis on how to interpret the profitability and the liquidity of our assets. So here we're going to do some brief ratio analysis. So this is what is involved basically in corporate finance. So lastly, we also need to understand that as a financial manager, you need to harmonize the goals of a firm to that of the shareholders. So effective and efficient financial management will require you to understand what the firm is there for. You must understand that there are two antagonistic ideas that exist in a firm, whether to maximize the wealth of the firm in terms of shares or dividends, or to maximize the wealth of the shareholders themselves in terms of having an appropriate dividend policy that will favor them. So this is what the financial manager should look at. So in this context, we're also going to look at our time value of money and how to compute the time value of money. Like I said, in this course, we are going to do a few computations that have to do with time value of money. So straight away, I'll take you to time value of money. They say time is money. And so we need to understand the value of time in terms of money. So the value of money that we have now is called the present value. So present value is the money that we have now. And the money that we're going to have tomorrow is called the future value. We denote this as what? FV. So if you'd be asked as a financial manager to say, what would you prefer? Having 1,000 kwacha today or 1,000 kwacha tomorrow, you obviously say, I'll need 1,000 kwacha today because tomorrow will be reduced by inflation or a discount rate. So in terms of time value of money, we're going to look at two kinds of interests that will be for this particular course, that is called simple interest. And there's also what we call compound interest. Interest is charged or earned on an investment. So if you are doing a savings, depending on the type of interest structure you're using, you get a fixed amount of interest added on the principal that you started with. If you're using a compound interest basis, you're going to get an interest based on the immediate previous amount that you accrued. For instance, if you have 100 kwacha and you are told that you have a simple interest of 10%, for the first 3 years, you're going to have 10% of 100 will be 10 kwacha. So meaning you're going to have in year 1, year 2, and year 3. So if you're going to add the interest of 10 kwacha here, so year 1 you're going to have 110, year 2 you're going to have 120, year 3 you're going to have 130. So this follows what we call arithmetic progression. The same 100 kwacha can be compounded at a compound interest, whereby the interest will be based on the future value or the present amount accrued. So the first amount in year 1, if we're going to do 10% of 100, we're going to have a 10 kwacha. So the interest that we're going to have will be a 10 kwacha to have 110. However, in year 2, 10% will now not be on the 100, but will be on this accrued figure there. So 10% of 110 is going to be 11. So the future value that we're going to have will be 121. And in year 3, we're going to calculate 10% of this 121 to get 12.1. So when we add that, we're going to get 133.1. Now this computation here has a formula that we need to follow. So the first part, like I said, follows what we call simple interest. And simple interest is simply given by PTR. P means the amount we started with, T means the time in years, and R means the interest rate. So simple interest for an amount that we invest, for instance, 1,000 kwacha in 3 years at a rate of 8%, what becomes our simple interest? So our simple interest in this case will become the 1,000 that we have here times the time, which is 3 years, times our interest, which is 8%, or in decimal, we're going to have 0.08. So computing that, we're going to have 240 as our simple interest. So this interest will be accrued in 3 years, but the future value will therefore be the 1,000 we started with plus the 240 that has been accrued. So our total amount in this case will be 1,240. Now, this is when we are compounding on an annual basis. To compound is simply to add interest. So in this course, you're going to need to familiarize yourself with these terms. When interest is compounded annually, it means you're earning interest once. When interest is compounded semi-annually, it means you're earning interest twice. If interest is compounded quarterly, it means you're earning interest how many times? 4 times. If interest is compounded monthly, it means you're earning interest how many times? 12 times. If interest is earned weekly, how many weeks are there? 52 weeks. If interest is earned daily, how many days are there? 365. If interest is earned continuously, we're going to use present value, e to the power RT. Now these are very key for you to understand, because this will be the basis upon which all the other topics will be hinging around. So suppose we're told that you started with an amount of 1,000 kwacha now, and this is at an interest rate of 8% for a period of time, 4 years. And you're asked, part A, find the future value if it's compounded annually. Then you're told, find the future value if it's compounded semi-annually. It asks, find the future value if it's compounded quarterly. It also find the future value if it's compounded be continuously. Now, these are very important to understand. So the future value and the time value of money is given by the present value 1 plus r to the power time. This is when you're dealing with an annual basis. Future value is the amount we're getting tomorrow. If you're compounding more than once, the formula becomes 1 plus r over m, mt. M is the number of compoundings. So, but A, future value annually, just going to use this one, the annual formula. However, I like this general formula because it applies everywhere. So what is the future value we're going to have in 4 years? So the present value there is what? 1,000. Our interest rate is what? 8%. So 1 plus 0.08. And our time is how many years? 4 years. So 1.08 to the power 4 times 1,000 will give you 1360.49. This is people's money, so you need to ensure you indicate that. So we're going to have 1,360. Of course, the 360 is the interest, the compound interest, but the future value is 1,360. Suppose you're doing the semi-annually, it's the same 4 years, but now the formula that we're going to use is this one here, because we are compounding more than once. So here we're going to have 1,000, 1 plus r. Our r is 8%, but the m, how many times are we compounding? Semi. Semi means 2. So we're going to divide by 2, and the 2 we're going to multiply the time there. So in this case, we're going to have 1,000, and this is 1.04 to the power 8. Are you understanding what is happening there?
Yes, we are following.
So meaning our future value here will be 368.57 because we are compounding semi-annually. Suppose we are compounding quarterly, Mr. Kavika. What will happen here? We have 1,000, and here we're going to have 1 plus what?
Quarterly is over 4.
Correct. So the 4 will be here. The 4 multiplied by the time, which is 4. Incidentally, the time is 4. So here we're going to have 1.02 to the power what? 16. So when you multiply that, we're going to get 1372. 72.79. So this is when we are compounding quarterly.
Okay.
Continuously, remember the formula was what? Future value is equal to present value e to the power rt. So the future value in this case for 4 years will be 1,000. Our e is on the calculator, our r is 8%, and our time is 4 years. So this is a computation on the calculator. So 0.08 times 4, then you do your e is found on the calculator times 1,000. You're going to get 1377. 77.13. So you see, the more you compound, the higher the interest. So we are understanding that when you invest money now, years from now, it will grow. So the interest rate has 2 terms that we're going to look at. There's what we call the annual percentage rate or the effective annual rate, which is given by 1 plus R over M, M minus 1. So suppose you're given a 12% and you're asked to find the effective annual rate if it's compounded quarterly and if it's compounded monthly. So in this effective annual rate is very important in finance because it is a real return that is earned on the savings that are invested. So any interest-paying investments, they usually consider the effective annual rate because it reflects the real percentage that is earned on a loan or an investment. So in this case, we want to calculate the actual end investment. So it has nothing to do with time there. So if we're dealing with a quarterly basis, our effective annual rate will be 1 plus 12%. Quarterly, we're going to put a 4 there. And the power 4 minus 1. So 0.12 divided by 4 plus 1 to the power 4. So we're going to have 12.55%. That is effective annual rate we're going to have. If it's monthly, what are we going to do? 0.12 over 12, the power 12 minus 1. So 12 divided by 12 plus 1 to the power 12. This one will give us 12.68%. So you see, the more you compound, the higher the actual interest that is earned on an investment. So these interest rates are very important to understand. For a course specifically, be asked to calculate such interest rates. The rest that follows will simply be subject of a formula. For instance, they ask you, how long will 1,000 take to double? How long will 1,000 kwacha double? At 6% compounded annually. So what do we have in this case? They're asking for time. How long is time? Present value that we have now is 1,000 kwacha. The future value is 2,000 kwacha because to double is multiplied by 2. They're saying how long will it triple? The future value is 3,000 kwacha. And the interest rate is what? 6%. So using the annual formula, the future value is equal to the present value, 1 plus R, the power time. So our future value in this case is 2,000. Our present value is 1,000. Our interest rate is 6%. Our time is what we are looking for. So we divide both sides by 1,000. So we're going to have a 2. And here we're going to have 1.06, the power time. Whenever time is unknown, we introduce logs. So here we have log 2, log 1.06 to the power time. So this time of 4, we're going to have t log 1.06. Find our time, we're going to divide both sides by log.
Yes.
Are we together?
Yes.
Yes, yes, we are following.
So log 1.06. So this is the foundation for this whole course, because once you understand this, we're going to move together on bond valuation, because everything hinges on these basic principles. So it will take 11.89 years to double. Similarly, they would ask you at what rate will 1,000 triple? At what rate will 1,000 triple? In 5 years, if compounded annually. So what are they looking for?
The percentage.
Yes,
The rate.
they're looking for the rate. So the formula we're using is this annual formula. So in this case, what is our future value? $3,000. All right, and what is our time? 5 years. Where's the 3,000 coming from? The weight triple. At what rate will it triple? So we're going to have 3 is equal to 1.1 plus r to the power 5. So here is just an issue of operations of math here. We cannot touch the r before we remove the power there. So we multiply it by the reciprocal on both sides. So 1/5, so that we released what is in the brackets. So 1/5 is the same as 0.2. So 1 plus r, 3 to the power 0.2 will give us 1.2457. So to find the rate, this one will go to subtract from the other side. So meaning our rate was 24.57%. Are we following? So here we're just using operations of math, just using just one formula to understanding the concepts that will guide us through. And finally, they'll ask you how much must be deposited now. Okay, how much can Banda deposit now to earn 80,000 after 7 years at 2% semi compound interest. So in this case, we're looking for what? The present value.
Present.
The future value has been given as what? 80,000. And our time is 7 years. Okay, and our rate is 2%. We're looking for the present value. So here it's compounded more than once. So the formula we know is what? Future value is equal to what? Present value, 1 plus r over m, mt. Our m in this case is 2 because the semi-annual. So if you want, you can make the present value formula subject. So this is same as future value, 1 plus r over m, mt. Everything is coming from the foundation of what we started with. So 30,000 here, the interest rate, 1 plus, our R is 2%, 2.02 over 2, and the time is what? 7 years. So we're going to divide our 30,000 by this interest factor there to give us 26,098.89. So this is how much must be deposited now for us to earn a 30,000. So these questions in an exam setting will be twisted a bit. They'll bring you a scenario where you'll be asked to pay school fees. How much must be deposited at this point with this particular interest rate to earn these particular figures? So understanding the benchmark of this course starts from time value of money. It must be mentioned to say that in this course, you also need to understand the theoretical part of it, because this lecturer is a little bit subtle. Where you're expecting calculation, sometimes you come up with theory part. So I will need to emphasize this so much. This is the longest topic that you have in this course, because it also has annuities and bond valuation. So I'll look at the annuities in the evening. I also look at loan amortization. I need you to understand what I've discussed so far. Is there any questions? Is it clear?
Maybe I just need to find out. I joined the class later, the situation. I don't know if this one is going to be recorded also.
Yes, I'll send the recording.
Oh, okay, thank you.
All right. Any other questions?